Right now, at this very moment, silver is trading at two completely different prices on the same planet. In Shanghai, physical silver sits at approximately $102 per ounce. In London, that same metal costs around $86. That is a $16 gap. That is not a rounding error. That is not a data glitch. That is a fracture line running through the global financial system, and it is telling us something that the mainstream financial press is almost entirely failing to explain. So let me walk you through exactly what this is, why it happened, what it means for every market participant on Earth, and why the story of this silver split is really a story about a 4-decade-old pricing system finally beginning to crack under the weight of forces it was never designed to handle. Pay attention to this next part. To understand the split, you need to understand one date, January 30th, 2026. On that single Friday, the silver market experienced one of the most violent single-day price collapses in modern commodity history. Silver had been trading at an all-time nominal high of $121.64 per ounce, a price confirmed by Trading Economics, a price that represented a jaw-dropping 320% rally from where this metal started in early 2024. And then, in a matter of hours, it fell off a cliff. By the close of Western trading, COMEX silver had crashed 30 to 36%, settling in the low 78-hour range on futures markets. The LBMA in London recorded its worst single-day performance in living memory. Think about what that means. In one day, 30%. Gone. But here's where it gets genuinely fascinating. Shanghai did not follow. While New York and London saw prices obliterated, the physical silver market in China held. It pulled back, yes, but it did not collapse. And within days, as Western paper prices settled and began recovering toward the mid-80s, Shanghai physical silver was trading at a persistent, stubborn, and historically significant premium, not a small one, not the kind of minor spread you see in normal arbitrage windows. We are talking about a premium that, at its peak, reached $22.98 per ounce, as documented by market analyst David Jensen in a detailed public report. That is roughly 29% above the Western paper price. Let that sink in. Two prices, same metal, same planet, 29% apart. And here is what nobody in the mainstream financial press is telling you clearly, that divergence is not an anomaly. It is a diagnosis. It is the silver market's equivalent of a stress test result, and the stress test just revealed something serious about the architecture of Western commodity pricing. To understand why, you need to understand the fundamental distinction between what traders call paper silver and physical silver. When you trade silver on the COMEX in New York or through the LBMA in London, you are overwhelmingly not trading actual metal. You are trading contracts, promises, digital entries in a ledger that represent a claim on silver that in most cases never actually changes hands. The contracts are settled in cash. The leverage is extraordinary. According to analysis from CPM Group cited in Basel III, research and confirmed by multiple market analysts, the paper-to-physical ratio in the silver market sits at an estimated 300 to 377 paper claims for every single ounce of deliverable physical silver. For context, even the gold market, which is itself highly leveraged, runs at roughly 100 to 1, 300 to 1, in silver. Now here is the thing about leverage at that scale. It is extraordinarily efficient when things are calm. It allows price discovery, it provides liquidity, it keeps markets functioning. But when something disrupts the physical supply of that underlying metal, the leverage does not buffer the shock. It amplifies it catastrophically. Because when 300 paper claims suddenly want to convert into actual deliverable metal, and there are only enough bars in the vault to satisfy one of them, you do not have a pricing mechanism. You have a game of musical chairs with 299 players in one chair. That is not a future risk. That is the current situation in the Western silver vaults right now. Here is what they are not telling you. COMEX registered silver stocks, the metal that is actually available for delivery against futures contracts, fell below 90 million ounces in February 2026. The specific number, as reported by Kitco and confirmed by official COMEX depository statistics dated February 12, 2026, was 88,291,059 ounces. To put that in perspective, on a single day, February 11, 2026, a single-day negative adjustment of 3.25 million ounces was recorded in the registered category. In the first week of January 2026 alone, 33.45 million ounces were withdrawn from COMEX warehouses in just 7 days. That is 26% of total registered stocks vanishing in 1 week. COMEX inventories have fallen 31% since October 2025. And in London, the situation is not better. Silver Bullion Singapore, which publishes regular vault supply updates, confirmed that as of February 10, 2026, London silver inventories at the LBMA had declined to approximately 450 tons. The Silver Institute, in its February 2026 market outlook, described London's physical liquidity as, quote, relatively tight, and warned that this tightness has directly amplified upward price momentum, so the metal is draining from Western vaults, and it is going somewhere. It is going east. This is where the story of the Shanghai premium stops being a technical market story and starts being a geopolitical one. Because that $16 to $23 per ounce premium between Shanghai and London is not an invitation to profit for Western traders. It is a one-way valve. It is a structural incentive being carved into the global silver market by a combination of Chinese policy decisions, accumulated trade war dynamics, and a physical supply reality that years of paper-dominated pricing simply failed to price in correctly. Let me walk you through how China built this premium deliberately in sequence. On January 1, 2026, China implemented new silver export controls. Reuters confirmed that only 44 companies are now authorized to export silver from China over the 2026 to 2027 period. This was not a surprise. It was part of a broader playbook that China had been telegraphing for 2 years. Starting in April 2025, China began rolling out export restrictions on rare earth elements and critical minerals, including dysprosium and 6 other high-demand materials, according to the Center for Strategic and International Studies. In October 2025, the Ministry of Commerce expanded those controls further. CNBC reported at the time that Beijing was, quote, echoing its rare earths playbook in the silver market. What China recognized, and what Western markets were slow to fully price in, is that silver is no longer simply a precious metal. It is an industrial strategic commodity. It is the second most electrically conductive material on Earth. It is inside every solar panel, every electric vehicle, every AI server, every advanced weapons system. According to Heraeus analysts, silver paste alone makes up 30% of total solar cell manufacturing costs. Every gigawatt of solar capacity installed on this planet requires silver, and global solar installation is not slowing down. This is why China's relationship with silver is not passive investment. It is strategic accumulation. Think about this. China sits at the center of the global solar supply chain. China manufactures more solar panels than any other nation by an enormous margin. Chinese companies consume silver at a scale that has no Western parallel. And now China has restricted silver exports, meaning metal mined or refined in China stays in China, while simultaneously running a domestic silver futures exchange, the Shanghai Futures Exchange, where prices reflect genuine physical scarcity rather than the leveraged paper dynamics of New York and London. And then, on February 9, 2026, the Shanghai Futures Exchange did something even more significant. It raised the financial requirements for holding silver positions, a direct move to cool speculative excess in its own market. And effective February 27, 2026, the SHFE announced a rule change that market participants described as declaring war on paper silver. Hedging positions in the delivery month and the month before would be automatically set to zero contracts, forcing anyone holding near-term silver contracts on the SHFE to either take physical delivery or get out. No more rolling paper bets indefinitely. No more synthetic positions substituting for real metal. If you hold a position into the delivery window, you are getting silver. This is a fundamental philosophical difference from how COMEX operates, where cash settlement and position rolling are standard practice and physical delivery is the exception rather than the rule. Here is what that difference means in practice. The SHFE is tightening the link between its paper price and its physical price. COMEX has historically loosened it, and as that gap in market philosophy widens, the gap in market prices follows. Let that sink in. Now let me add one more layer to this, because the physical supply situation is not just about vault inventories, it goes much deeper. The Silver Institute, the global industry's authoritative data source, confirmed in its 2026 market outlook that this will be the 6th consecutive year of structural supply deficit in the global silver market. 6th consecutive year. In 2024, the annual deficit was 148.9 million ounces. In 2025, the deficit was approximately 117 million ounces. Over the 5 years from 2021 through 2025, the accumulated shortfall between global silver supply and global silver demand reached an estimated 900 million ounces, according to Mining Weekly's January 2026 reporting. 900 million ounces. You need to feel the weight of that number. That is not a market in temporary imbalance. That is a market that has been running a structural deficit for half a decade, covering those gaps by drawing down above-ground inventories, specifically the vault stocks held at the LBMA in London and the registered stocks at COMEX in New York. And those stockpiles are not infinite. They are visibly draining. The inventories that were buffering this deficit for years are now the inventories that are actively being shipped to Asia to chase the higher Shanghai price. David Jensen's February 2026 analysis confirmed the mechanics precisely. With Shanghai physical silver at a $22.98 premium over Western paper prices and air freight costs running at approximately $2 per ounce for bulk silver, the net arbitrage available to anyone willing to physically move metal from a Western vault to China exceeds $34 per ounce after accounting for China's 13% value-added tax on imported silver. That is not a small spread, that is a gold rush. And so Western vault silver is flowing east because the math says it must. Pay attention to this next part. Here is where history becomes essential, because we have been here before, sort of. In 1979 and 1980, two Texas oil billionaires named Nelson Bunker Hunt and William Herbert Hunt attempted to corner the global silver market. They accumulated an estimated 200 million ounces of physical silver and futures contracts, pushing the price from roughly $6 per ounce in 1979 to a then all-time high of nearly $50 per ounce by January 1980. The response from the establishment was swift and decisive. The COMEX changed the rules mid-game, limiting silver futures positions and essentially forcing the Hunts to liquidate. On March 27, 1980, a date now known in commodity history as Silver Thursday, silver crashed 50% in a single day as the Hunts failed to meet a $100 million margin call. The parallel being drawn today by market analysts at Equity, Seeking Alpha and elsewhere, is instructive. But the differences are more important than the similarities. The Hunt brothers were two individuals attempting artificial price control. What is driving the current divergence is not artificial. It is fundamental. It is not two billionaires buying futures contracts. It is 6 years of supply deficits, 900 million ounces of accumulated shortfall, geopolitical weaponization of export controls, AI and solar demand that did not exist in 1980, and a Western paper market system leveraged at 300 to 1, trying to price an increasingly physical, increasingly industrial, increasingly strategic metal. The Hunt brothers episode ended when the rules were changed to stop them. The question the market is now asking, quietly but insistently, is this: who changes the rules when the imbalance is not caused by two men in Texas, but by the structural gap between how Western paper markets price metal and what physical metal actually costs to obtain? This is bigger than one market. This is about price discovery itself. Because what the Shanghai premium is revealing is that price discovery, the fundamental process by which financial markets determine what something is actually worth, may be migrating from west to east for this particular metal. And if it migrates for silver, it does not stay there alone. Silver is a bellwether. It is the canary. And the canary is singing a song that New York and London have not fully heard yet. Let me be precise about what the numbers are telling us as we stand right now. Silver hit an all-time nominal high of $121.64 per ounce in January 2026, confirmed by Trading Economics. That surpasses the Hunt brothers' era peak of roughly $50 per ounce from 1980 in nominal terms, though not in inflation-adjusted terms. After the January 30th paper crash, Western prices settled around $78 before recovering to the mid-80s. Citi analysts, in a widely reported January 2026 forecast, said silver could reach $150 per ounce in 2026. J.P. Morgan's 2026 silver price forecast, published publicly, projects an average of $81 per ounce for the full year, which implies significantly higher peaks, given where we currently stand. Visual Capitalist's long-run silver rally analysis shows the 2025 to 2026 move as the largest percentage rally in the metal's recorded modern history, at 320% from trough to peak. Think about what this means for the larger picture. This is happening within a specific macro context. Gold has already surpassed the US dollar as the world's top global reserve asset, according to the Economic Times citing central bank reserve data. The dollar's share of global foreign exchange reserves has dropped from approximately 71% in the year 2000 to 58.4% as of Q1 2025, according to IMF data cited in Discovery Alert's de-dollarization analysis. J.P. Morgan, in a note to clients cited by The Street, now expects gold to reach $6,300 per ounce by late 2026. CNN ran a February 2026 analysis headlined, "China reveals its plan to challenge the US dollar for dominance." Silver is not sitting outside this story, it is inside it. Physical precious metals are increasingly understood by central banks, sovereign wealth funds, and institutional investors as insurance against a monetary system under stress. And when China restricts silver exports, when the SHFE rewrites its rules to force physical delivery, when vault inventories in London and New York drain at record pace, it is not coincidence. It is strategy. It is a nation that holds enormous industrial demand for silver, simultaneously positioning that demand as a geopolitical lever. Here's what nobody's talking about loudly enough. The implications for Western consumers of silver, and there are many, are not abstract. Solar panel manufacturers, semiconductor fabricators, electric vehicle producers, medical device companies, all of them depend on silver at the industrial scale. If the effective price for physical silver is not $86 as London quotes, but $102 as Shanghai prices it, and if Western vault inventories are draining to chase that premium, then at some point, the Western industrial consumer faces a stark choice. Pay the real physical price, not the paper price, or face shortages. China's LONGi, the world's largest solar panel manufacturer, announced in January 2026 that it is beginning mass production of solar cells using copper metallization instead of silver, as reported by PV Magazine. This is not a minor tweak. This is the largest solar company on Earth re-engineering its core product to eliminate silver because the price has gotten so high. Silver paste now makes up 30% of solar cell costs, and at $100 per ounce and above, the economics of substitution finally become compelling enough to act on. But substitution takes years. It requires retooling factories, validating new products, scaling new supply chains. In the interim, demand remains, deficits persist, and the gap between paper price and physical reality continues to be exposed every time someone tries to take actual delivery. This is the essence of what the Shanghai premium is screaming at anyone willing to hear it. Paper markets are pricing a world in which silver is abundant, leverageable, and easily rolled into the next contract month. Physical markets are pricing a world in which silver is scarce, strategic, industrial, and increasingly subject to national export controls. Both prices cannot be right simultaneously, and history, without exception, tells us which one wins in the end. So where does this leave us? What actually happens next? The arbitrage cannot persist indefinitely. Metal flowing from Western vaults to Shanghai will continue until one of three things occurs. Either Western paper prices rise to meet physical reality, eliminating the premium and making the arbitrage uneconomic, or Western physical supplies run down to a level where delivery of paper contracts becomes impossible, forcing a chaotic repricing, or new supply comes online fast enough to replenish vaults, which the Silver Institute's own data shows us is unlikely given that total global mine production is expected at 820 million ounces in 2026 against demand that will still generate a deficit in the 67 million ounce range, according to Metals Focus. None of those three scenarios is pain-free for Western market participants. The first means acknowledging that silver has been materially underpriced in paper markets. The second means a structural market crisis. The third means waiting for geological and capital cycle timelines that move in decades, not months. The silver market is not broken. It is in the process of repricing itself. And the Shanghai premium is the most honest real-time indicator of how wide the gap currently is between the price we are told silver costs and the price it actually costs to put a bar of it in your hand. That $16 difference between Shanghai and London is not just a spread on a chart. It is a signal. And every ounce that leaves a Western vault to chase it is a data point confirming that the signal is real. Stay informed. Watch the COMEX registered inventory numbers every single week. Watch the LBMA vault reports. Watch whether the SHFE's February 27th rule change triggers a further premium expansion or a market resolution. Watch whether Western industrial consumers start reporting supply constraints. Watch whether other nations follow China's critical minerals export control template and apply it to silver. This story is not finished. In fact, by most structural measures, it is only in its early chapters. The question is not whether the Western paper and Eastern physical prices will eventually converge. They will. The question is how, and who absorbs the cost of that convergence. More truth and accountability.